everybody. Midweek. Everyone enjoy the full moon last night? Anyone see the eclipse? Hiya, Tom, Aruxande, and Claudia. Thank you for your good morning wishes. So one of my turnaround Tuesday candidates that didn't turn on Tuesday still think he has a chance to turn. Conservatively, you would wait for the market to get back under 90.21. I'm not that conservative. So, it almost looks like a 1, 2, 3 up here. One pretty good divergence under 70 at the last high, 68. So looking for a failure in here. The reason I'm resolute about this is downside objectives that I see, and really we haven't had one correction all the way up from this 85, 84.80 level. Was at the lower 84.80. So you're talking about close to 600 pips, 570 pips. So halfway back would be about 300, and I have some confluence here around the 87.50 level. 87.60 is going to be halfway back. Here's a few of the speed lines. There's the other one that'll come in above 88. So that's my look on EG. I think part of it will be that the dollar so far is failing to take out 97.5. And I'm still expecting one more decline before the huge dollar rally to above par. Gold-silver ratio was a huge winner. Even if you didn't do it with leverage and you just did it with your physical. So I remember saying that you can exchange your gold for silver and you're getting much more bang for the buck. I think this is only beginning, because if you look at it on a weekly basis here, I think this is going to be a reversal week to the downside. Well, it actually started last week. So 86 is viable. It's not too late, and it's only the first wave down, and then there should be some type of failing rally. But, there's potential for a lot more. Let's just take a look at the monthly. As you can see, we made as far back as TradingView goes. We took out the highs, and for look at where it traded in 2011, this ratio. So let's call it, in big round numbers, 30 to 90. Halfway back would take you to 60. And in my commodity career as an IB and everything, is pretty normal to see 40 on the gold silver ratio. So this is just starting. Okay, you're not late if you didn't sell the top. In fact, now you have more confirmation than you did before the top. So that's the look there. Yesterday at the opening, I showed Bitcoin as a descending triangle, and the breakdown did happen. And I actually had some lines here. Yeah, that could take it down to about 7,000, which would, I think, be about halfway back. This was one of the speed lines I had here. Something like this. And then when you look at the daily, you could end up having some convergence between the 200-day and this speed line. And, it could be something like this. C waves can be, I don't think this is the end of Bitcoin and we're going back down to 3,000. I think this is just going to be a correction from the 3,000, 3,500 level. And if you look at this high on Bitcoin up here, I guess you could comp it to here, but pretty good reading. So if you look at this 14,000 and then take 1.618 of this, it also takes you down to about 7 grand. Everyone see that and understand it? What I'm thinking here? Okay, we're also at some critical juncture in the bonds. Perhaps the bonds have one more pop left in it, but looking at TLT, you know, it's hanging right here at the throwover line. See how many throwovers we're getting here lately? And you know what's interesting about having throwovers is they're really shakeout moves, because a lot of people try the wedge lines and then then they give up. Now we're back inside of it, so the wedge is still valid even though we've had a throwover here. So it's flirting right here with the 50-day moving average. This is TLT. It's like a 20-year bond. That's about the duration of it. So, you know, rates are really everything. They're what's driven the market. There's what's driven gold, no opportunity cost. And we really are beginning to reach a moment of truth if this last rally in yields is just another failing rally, or we have something else going on here. So here you go. So here's a 10-year yield. As you can see, we're back inside the wedge on the 10-year, trying to hold it. And here's a shorter term look. You know, we had this nice, well, let's look at this. Very nice rally off 194 back in the wedge line. Look, this line means something. Tagged it and then got the pop yesterday. So far, we haven't been able to get back through here. And, you know, almost looks like a continuation formation, and we get through 214. You could be talking 235. I know a lot of people aren't talking about it, but here's your 235 level right in here, previous support. That would actually take us outside the falling wedge. 227 would do that. So really reaching kind of the moment of truth and yields. Is this just another oversold bounce? And I know some people talking 170, or is the surprise going to be with the Fed easing that yields are going to, the bond vigilantes are going to want to get paid more on 10-year and 30-year paper. So this is really the key driver. As rates went down, everything went up, except maybe, you know, euro. It stabilized the euro, but stocks went up, gold went up, oil went up. So free money makes things, forces people out into the risk curve. And if the money isn't as free, and if you believe in wedges, and it's, you know, even I'm having a hard time believing that we could get back towards 3% in the 10-year bond, but if you believe in technical analysis, it has that potential. And this would be the surprise of the summer should it happen, because no one is looking for higher yields that I hear or read about anywhere. So it's really a great backdrop narrative of the Fed's easing. They're going to cut in July. The market talking about maybe another 2 cuts. So why would yields go up? You know, people are going to go, why aren't yields going down? The Fed is easing. Well, it's because they only control the short end of the market. And I'm talking, you know, not even 2-year notes. I'm talking 90-day paper, 30-day paper. So T-bills, actually. So keep an eye on this. We start getting back through this line here at 226. The picture has changed in the bond market, which means the picture has changed for markets having competition for getting something for doing nothing and not taking the same kind of risk you would on some of these IPOs in the stock market. Just a quick look at the S&P before I turn it over to Blake. You know, I'm tempted. It looks like a little 1, 2, 3 here. You know, we're into this time window. It just doesn't feel ready yet to me. There were targets 30, 40, 30, 50. When Steve comes on, he'll show you the megaphone. You know, the megaphone is this type of broadening top formation. So let's just look at what the weekly off number would be. I know if we got back under 2960, this level right here, you got a problem in River City, okay? So for us to have a 2-week reversal in the S&P, write this number down. And when I talk about weekly reversals, what day do you need it to close before you even know if you have a weekly reversal? Will we know today? It's Wednesday. Will we know tomorrow? It's Thursday. So we won't know till Friday's close. And if we close back under, get this out of the way here. The market has a memory, and all the market's memory is to the left-hand side. 2986.10. So, you know, that's within earshot. 2986.10. It's right here. So that's your 2-week reversal in the S&Ps. We close under that. A correction could be, that's a pretty good signal. I like these 2-week signals. So keep an eye on that number, definitely under this support level that held. This was resistance, support, held it by a thread and accelerated. So 2960 is really what I would consider intermediate term traders, bull bear line in the sand. And speaking about bull bear lines in the sand, that's what you get when you're taking pattern and plays. They always give you an invalidation number, okay? So if you have an invalidation number, that's your bull bear line in the sand, okay? If you're taking these, you got to pay attention to these. These are your stops, okay? Yeah, you could adjust them. You could trade off these pattern and plays, but you start getting closes under any of these numbers, don't use a mental stop. Get out of the way. Steve is, what is he, on 10-year? He's bearish. Oh, okay. Greg doing very well in Aussie. Greg doing very well in CAD Yen. So why not join? Why not join? You have everything at your fingertips here, right? You have Blake, you have Grega, you have Andre. And you know what? Once you join, you could hang out with everybody in the chat room. And that includes Amanda's great calls. And I know Amanda's not surprised by where we ended up going in EG. In fact, because of that, I think she said 34 when we were just all talking to each other, 90.34, actually gave me a little bit more conviction to go ahead and take the trade. So I want to wish everyone good luck today, good hunting. Thank you for hanging out with us in face. In my extremely humble and accurate opinion, I think it's the best FX webinar for content, paid or free. Anyone agree with me? I know I'm just tooting my own horn, but where else can you get this type of input from 8 a.m. to 9:30? We also have a great guest. Thank you, Tom. We have Ronnie Stoffler at Incrementum, and he does a lot in the metals arena. And I'm looking forward to talking to Ronnie. Stick around, he'll be with us at the top of the hour. And I'm going to turn it over to Blake now. And I know that Blake was thinking that we'd probably be holding this 112 area in the euro, and we still are. So I'm wondering if his ideas have changed, or what is it, Blake? 112 being tested a few times here?
Yeah, 112 is important. And good morning, Dale.
Good morning, bro.
Good morning. I think 112 is important for a few different reasons. I think that obviously you want to hold it as from a constructive point of view. You want to hold it just to keep us creating higher lows. Excuse me, but even if we do slightly break these lows, as long as we can hold this 111.80, there's minor channel support here, which I think is important for the market today. It's unfortunately a very slow market. The majority of the volatility that we're going to see is going to be in the Canadian pairs, because we do have Canadian CPI today. You can see, the data that's being released. We have Canadian CPI. We do have building permits and some housing data out of the U.S. But overall, pretty slow day. And I'm not sure if it's going to be too terribly exciting aside from the Canadian data. But yeah, going into the euro, I think this is going to be pretty important support all the way through here. Let me go ahead and kind of put that out here. All this, 111.80, 111.90 is all going to be pretty key support. One thing that you said your guest is bringing on. He talks about precious metals. One thing that I can't stop looking at is silver. It's bullish here. I mean, we're continuing to rally here in silver. Gold's stationary, and
when's the last time you've seen that?
What?
Gold doing nothing and silver exploding.
Well, yeah, it's been quite some time. I mean, the gold silver ratio is starting to move lower, which we haven't seen in quite some time. So, but it tends to be a more bullish sign for the metals complex.
Blake, I was kind of thinking about it, and I subscribe to that theory too, but there's also another way to look at it. I know that you got your start in equities, right? So when equities are going, it's the blue chips, it's the S&P 500, and then towards the end of a move, they move to the more speculative type stocks like the Russell or internet stocks, and sometimes what you call it the trash begins to way outperform the blue chips and the quality, which at times is the tail end of a move rather than the beginning of a move.
So are you suggesting that the more speculative silver is going higher, which might be the tail end of this this move?
I think it's a possibility, but I do think silver will get up to 1620.
Right.
So I'm going to be very interested to see where gold is at 1620. I have no idea where it's going to be because of the way it's trading, but that to me is going to be a level to play. And it is kind of like the junkie stocks all of a sudden begin to outperform. So something, just a counter argument. I always have the devil's advocate in me.
No, I hear what you're saying. Well, as long as gold continues in this triangle, in this pennant, I'm not really too worried about it. I actually, my cost average in gold right now is at this 1404.
Oh, it should break out to the upside. I agree with you, Blake.
Yeah, I would think. The question is, how far are we going to go? I still think it's entirely possible here. If you're looking at just this pennant, here in gold, this move, it's just,
1600.
No, I mean, this one will take us to the bottom of this resistance zone, which would be, 15 and a quarter.
You have a 1.618 there.
Yeah, that's 161% extension of this last range.
Yeah.
But if you go over to a weekly chart, you can see how significant that is, because that's all that previous support comes into play from way back in 2011. So all those spike lows down there. Yeah. So I think that's going to be very significant on this move in gold. I look at gold, and unlike Stelios, which he thinks gold's going to, 5,000, right, Stelios? He thinks that gold's going to like
Jim Sinclair says 50,000.
Okay. Well, I don't think I'm not in the camp that gold is going.
When there are people that really think that Bitcoin is going to 1 million, I really haven't heard any extraordinary assumption for gold. I have to say that.
Yeah, I mean, yes, this is true, but those are obviously
you love Bitcoin, Steve.
He does. He's
Oh,
he's
yeah.
he's a Bitcoin lover.
You're such a great ambassador for cryptocurrency, Steve.
But I do think that
That
I think that gold can make a move up towards 1500 and slightly above. I'm not sitting here looking at gold saying it's heading to 2000. I'd be actually very surprised if gold hit a new trend high on this leg higher. I would be very surprised if we broke towards 1700. There are a few catalysts that could really put a bid in gold. I mean, if you think about it, a no Brexit, right? A no deal Brexit, I guess is what I meant to say, or no China U.S. trade deal. I mean, those are two specific events that could really put a bid in gold, which might actually drive it to new highs. I'm not counting on it. I'm just saying that I think that it's entirely possible. But one of the things I wanted to go over today, just ahead of the Canadian CPI numbers, is the dollar CAD. The dollar CAD, by the way, has been an extremely messy currency to trade. I've really haven't traded a lot of dollar CAD. You'll notice that we broke. Let me just kind of zoom out a little bit here so you can, and I'll just redo some of this. So you can see this big fib from, these are the lows in 17 to the highs that we made in the end of 2018. You'll notice that we're at a 38% retracement. So where we currently are is fairly significant from the fact that we've pulled back to a 38% retracement, which in essence is a minimum retracement if we have a bullish trend that is going to continue over time. If you guys are dollar Canadian or loony bulls and you're like, oh, well, the dollar Canadian's going back to 140. Well, that means that you want to really stop here at the 38% retracement to continue this bullish move over time. Excuse me 1 second. Let me just mute my mic really quick. I just had to clear my throat. Okay, so you can see why one of the reasons why we're consolidating down here. Also, if you take the most recent range of just this year, so you're talking, this is the 2019 range, and I can actually delete that fib for now. This is the lows of 2019 to the highs of 2019. Wasn't the low. We actually hit a fresh low over the course of the last week. But now we have this like little bit of a false breakdown. So I guess what I'm trying to point out here is because we had this potentially false breakdown over the last couple of weeks, if the Canadian data comes in weak, that could put a bid in the dollar Canadian back to this 131.50. Now, one of the other things that people tend to forget because of periods of low volatility is if you take a look at the VIX. Let's go over to I have the VIX somewhere. I'll have to type it in. There it is. Okay, so here's the VIX. Let me clean up this chart. I'm gonna just delete everything. So there's long-term chart of volatility. Believe it or not, if you match up the dollar CAD with volatility. Let's go over to a weekly chart. Might actually be able to. Actually, that's not showing us too good of a representation. What we have to do is we have to go over to volatility, and it's not going to do it either. One of the things that I think people forget, though, and I'll try to just it's not going to show up on this chart anymore. When volatility picks up, which because we haven't seen it in so long, when volatility picks up, the dollar Canadian tends to have a very strong correlation to it. So, I think it'll be interesting if we start to see the equity markets come under a little bit of pressure. If we see the equity markets come under a little bit of pressure, we might actually see volatility pickup, which would lead to the dollar Canadian catching a little bit of a bid as well. So, wow, the dollar Mexican peso just came under pressure. Hold on, any reason? I got filled on a bid. That's why I'm wondering if there's any specific reason. I don't think there's any specific reason. Anyway, the S&P, as you were talking about a little bit earlier, Coach, I look at it and I'm the same, you know, in the same camp as you. We did hit this this upper trend line, almost 127% extension, but unless we get below 2960, it's hard to be bearish. But you know, we had an evening star yesterday formation, which is bearish. So I think the S&P should continue to play to the downside today, but we'll see. I think this trend line support at 29.90 will be pretty key if we make a move down there. But anyway, going back to the dollar Canadian, one of the things that will put a bid in the dollar Canadian, not just the data, but would be the S&P coming under a little bit of pressure or volatility starting to pick up. So we'll see if that actually does come into play. I am playing the Canadian to the short side through some other Canadian pairs, through the New Zealand Canadian and Euro Canadian, for those of you that listen to the week ahead video, or are in the ForexAnalytix chat room. You guys already know I'm playing those to the long side. So we'll see how that plays out. But anyway, I'm going to pass it over to my colleague Steven Stelios. Good morning, guys. How are you?
Good morning, Blake.
Good morning. So, you know, I just read I forget, I think maybe it was Forex Live that said it. Parody.
If ForexAnalytix didn't say it, we don't care about it.
Parody on a no-deal Brexit. Some bank had.
Oh, wow.
Parody on a no-deal Brexit. We get a no-deal Brexit. I mean, you look at the cable, the euro pound's, you know, looking strong. The pound itself is looking pretty weak. You know, I could see I could see it coming under some pretty extreme pressure. So we'll have to see how the cable plays out the next couple of months here as we get into September. But anyway, I'm going to pass it over to you. I got to get to the CPI data, manage my trades. So you guys have a great trading session today. Good luck. Happy hump day to everybody. And make sure you try out ForexAnalytix if you haven't done it, and join us in the community as we're chatting all day long. If you want to know where I'm at, and Amanda, Joe, Steve, Stelios, that's where we're at all day long. So
good hunting today, Blake.
Thanks, guys.
Enjoy it.
You know, speaking of the pound, it's on a no-deal Brexit, there's definitely going to be some more pressure. But the question is, what is the market pricing? I personally think the market's probably pricing a 50-50 chance now. That's why we've seen the pound.
I think, Stelios, that even if we assume that that's the case,
yeah,
I think that even an unpriced 50% chance of a no-deal Brexit is going to create a seismic.
Oh yes,
event.
Yes, it is going to make a big event. Like if cable is where it is now, let's say it was today and we're at 124 and there was no deal Brexit, it would go to 120 straight away, I think.
I would really think that 110 would be doable. Not within the same day.
Yeah. It could be.
Yeah.
Interestingly, we had UK CPI today. Actually, we have 1 minute of data, so I'll just say this and that will be it. We had UK CPI came in at 2%, which is exactly the bank's target and unchanged from last month's reading. And remember, yesterday we had the earnings growth at 3.4%. So that's a nice little gap of prosperity for the average UK person. And so that's something to keep an eye on, and that's definitely something that the Bank of England looks at. But as we said yesterday, the more weeks go and nothing happens in terms of progress, then the chance of a no-deal Brexit will become bigger and bigger. So at what time do you fade it? I have started already to build up some long pound positions, but very, very slowly, because I don't think there will be a no-deal Brexit. But let's have a look at the numbers now. So we have US and CAD numbers. You know, the Canadian CPI, probably the most important one. And it is, oh, you took it away. Okay, core CPI 0. CPI month on month. CPI year on year 2% as expected. Core CPI weaker than expected year on year. So what is USD CAD doing? Yeah, not that much actually. And the US data, building permits and housing starts both missed, not by a huge margin, and not that they're not really going to make any big difference.
I just realized that I was speaking to myself because I was muted. I wanted.
Oh, you were.
And
okay.
then I forgot to unmute myself.
It's okay.
Yeah, so housing starts a little bit weaker. Canadian data, you already mentioned it. I just wanted to add to those manufacturing sales, which were weaker, 1.6 versus 2% expected. So far, we mostly see USD CAD unfazed. Here it is, by the way. Here is USD CAD. This is one possible bullish interpretation. As I said, from a risk-reward perspective, and only from a risk-reward perspective, USD CAD long positions are favored here against 130 because a break below 130 is going to be a very, very significant technical event. And obviously, I'm talking about a bearish one.
I'm smart and I'm funny and people like me. Oops, I was unmuted. I was doing my mantra. What wasn't that a Saturday night live routine?
So Stelios is texting his wife. You are having your monologue about your awesomeness. I'm going through data. Nice.
Okay.
You both suck.
Okay, actually, Steve, before you continue with more analysis, I just want to answer a question. Our friend Neil is saying, I really don't see how it will be bad for no-deal Brexit, considering that Europe has more to lose. Can you explain what the issue would be for UK for no-deal Brexit? I personally think, and I've said this before, in the long run, even with a no-deal Brexit, the UK will probably be fine, in the long run. They're going to make some trade agreements. They're going to find their footing. But in the first
in the long run, we're also all going to be
dead, yes.
So we don't
but
care.
In the first year or so, there's going to be, or two, there's going to be so much uncertainty. The transfer of goods and services is going to be, there's going to be quite a few obstacles because it will not be free well, not free, but you know what I mean. All the treaties at the moment, they ensure the smooth process, and this is all going to go. So they have to start not from scratch, but they have to. They have to work on it, and this will not happen overnight. And that's what we're talking about, the uncertainty that's going to happen, and maybe a liquidity issue or whatever kind of issue in the very short term. I agree. In the end, it's probably going to be, it's not going to be, probably going to be okay in the end. But, we're just talking about the short-term effects,
Yes.
6 months to a year of the currency, and it's probably not going to be good. You can't see anything positive about it. Let's put it
No, there is no question about it. Don't try to trade the possible long-term outcome of what that's going to mean, which, yeah, it might even turn being something positive for the UK in the long run. Who knows? Or completely neutral, right? I mean, they're going to build new agreements. They're going to put in place everything that needs to be put in place. I'm sure the UK is going to be okay in the long run. There's no question about it. But the market doesn't care about that. I mean, if you want to go into millions and millions of examples why the market is reacting as it is reacting in the short term to news that in the long run would actually be considered to be negative. Just take the simplest thing. Let's take the US, since it's the benchmark for developed economies, right? In that sense, every single time we see a good consumption number, we should be shorting the US economy, because we know that the vast majority of the GDP comes from consumption, and that's why the markets, react positively when consumption is high. But we also know that the vast majority of consumption happens through credit in the occasion of the US. So in the long run, we all know that this unpayable debt, at some point the markets are going to start caring about it, and it's going to be like a huge problem and a huge event. But are you going to start trading on that in the short run for something that the markets might keep ignoring for another 10 years, 5 years, 15 years? Who knows? It's going to also be a factor of unexpected events or whatever. So yeah, it's one thing what happens in the short term, and in the short term, no deal Brexit is immediately a huge red alert, because it's going to have negative repercussions, and a lot of and uncertainty increases exponentially for a period of time.
Yeah.
Now, later on, yes, I'm pretty sure that especially against the euro, the pound is going to recover a big part of its value. Let me say it very simply. I do believe that at some point within the next year or so, euro pound is probably going to offer an amazing opportunity to be short. Sorry.
Yeah.
So, but is this the time to do it? It might be in the short term, but not if we get a no-deal Brexit. The initial reaction is going to be, a spike higher for euro pound, for example.
Yeah. At these levels, if you
hey guys, I'm sorry.
Go.
When Grega was on last time, he showed euro pound, and he's looking for a pullback too, a little deeper than I think around the 86 level, but he had targets in EG up around I think 114.
Oh wow!
So
Yeah.
yeah, Grega's long-term wave counts I pay attention to. You know what I mean? Yeah. So that'd be something.
Well, one thing's for sure, if you're taking a position in sterling now, you're taking a bet on the outcome, end of story, because it's a 50-50 thing, and either way, you're gonna...
Exactly. And if you want to trade like this, why not go to the casino? Coach, you probably remember me showing that in the past. Keep in mind that euro pound bottomed out in 2015 at 0.70. We then had definitely a very, very strong move higher.
Yeah.
And after reaching a new high, we have now spent a big period of time consolidating and correcting over time instead in price.
So that builds compression for.
I agree 100% with Grega. Let me be clear here. Do I believe that there is an opportunity for a short-term short trade in euro pound? The answer is yes, I do. Do I believe though that this formation is going to get resolved to the downside? Not really, because I would believe that after a pullback, which I think from a risk-reward perspective is extremely appealing, we will see a new high before we see a much bigger move lower. Okay, now I don't know, and there's absolutely no reason for me to try to predict how high the next high is going to be. It might
94.
be 94, it might be 98, it might be parity.
The weekly, if you pull it up, would have a weekly, yeah.
There you go.
Okay. The weekly would have a 3 drive formation up around 94. You see the first one you have labeled 3, second one you have labeled 5. So one more shot up there would
as you see on the weekly, it was an impulsive move higher, right? There's no question about it.
So that's how you get probably Grega's 24 breakout, say over 91, it gives you 115. 2,400 pip move, right? If this is one huge bull flag, that's where it's going.
Yeah, and add to that, if you want to look at the much longer term picture, we bottomed out at 2000, right? We then kept moving higher until 2008. We then moved lower, but compare the move higher with the move lower.
Yeah.
Right? And then we broke higher again. Now we're consolidating again. You can even see this a little bit as a fractal, at a different ratio. See? So, yeah, I do think that euro pound is going higher. And I'm very, very skeptical that pound can escape another sell-off before things stabilize. I'm very, very skeptical. On the other hand, we've now had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 consecutive up weeks for euro pound. Do I believe that somebody should be buying euro pound here? No, I find it completely insane, right? So I do believe that it's an overcrowded in the short term. It's an overcrowded position, and I do believe that we're bound for some type of a pullback in which case, as I've told you, my first target is 88.50. But yeah, once we find support, I don't know if it's going to be 88.50 or if it's going to be a little bit lower. Might be the 200 daily moving average at 87.90 or whatever. I do believe that there's a very, very high chance that we're going to see much higher prices in Europound. But as I said, at some point in the future, I do believe that Europound is going to be an amazing short opportunity, because when the market will have ended up pricing in all the negativity about the UK, and any kind of outcome that we will have gotten would have already been fully priced in, and the UK, as it has always done in the past, will have fully adapted to, you know, whatever the new outcome is going to be. I do believe that the UK will have a very good chance of overperforming relatively the Eurozone.
And you have to think about, what will the Bank of England do? You know, if you were the Bank of England and you have this huge uncertainty, and the currency tumbles, and assuming that inflation stays roughly where it is, which, you know,
inflation can stay where it is if we have a huge stumble still. You know
well,
that.
yeah. Well, I'm not talking about the huge stumble, but, you know, if things start looking worse, and it's, you know, you have inflation where it is, maybe a little bit lower, employment where it is, well, employment is excellent, and earnings growth still pretty good, you know, much higher than inflation, and equities at very good levels, housing at decent levels. They can actually, if they want to, they can hike to support the
I believe it is a very likely scenario that they will have to end up hiking, or at least if everybody else is cutting rates.
Yeah, they stay where they are.
Yeah, to stay where they are. Exactly.
Yeah, they could do that.
Exactly.
But this is it's all hypothetical. You know, who knows what's going to happen, and the extent of the issue, the damage, basically, if there's a no deal Brexit.
Yeah. My intuition tells me the more the weeks pass, my gut feeling tells me that it is a likely scenario that we're going to have to go through that as well and see how it works out.
Okay, let's see.
I'm not very optimistic that they will find the solution. I don't know why. It's not that, you know, I have, you know, some inside information which I'm not sharing or whatever.
I think both sides are playing hardball and have been, and there's no room to maneuver. It seems so, especially from the European side. But I've said this so many times. It's in both sides' interest. Theoretically, it's in both sides' interest to have some kind of a deal. So, you know, I always say follow the money, and there's just too much money involved. But let's see what happens. You know, you never know.
Historically speaking, we've seen weirder things happen, though. Huh?
Yes, absolutely.
So I make no bet. I think that no matter what happens, even if you are not, which, as you very correctly said, Stelio, that would be a huge gamble to try to pick one side in advance, hoping that that's what's going to happen. I can guarantee you one thing for sure, though, is that no matter what happens, yes, you will lose the initial move, which usually is big, you know, in that occasion. But there's going to be follow through.
Yeah, and actually, I agree with our friend Neil, who says Europe will suffer. Actually, he says Europe will suffer more due to Brexit, and the euro seems to be going up. I agree that the euro will also suffer because, you know, the UK is the second largest economy in Europe, along with France, and the euro just seems to be oblivious of what's happening with the UK. It's almost as if only Brexit is only priced in sterling. That's why one of my preferred.
To be fair, Stelio, the market seems to be oblivious about almost anything nowadays.
Yeah, true.
I mean, it's unbelievable. I mean, we were saying that yesterday about the dollar as well. I mean, just consider, if we want to go back on the chart, let me remind you that here, and that is why this is a very tough period to trade the market. That's why you need to be nimble. Trust me, we will have again extremely good opportunities to trade the market. It's just a period. So here, the market thought that this year we would get 4 rate hikes. Stelio, am I right on that?
Yeah, 3 to 4.
Yeah. 3 to 4 rate hikes. So when the dollar was there, the market, theoretically speaking, was pricing in 3 to 4 rate hikes. Now, somewhere here, the market was pricing in 3 rate cuts.
Yes.
Look at the level. So
it's insane, right?
yeah, in this same range, the market thought 4 rate hikes. In the same range, the market thought 3 rate cuts. I mean, this market is completely oblivious to anything.
That's why I've said in the past, bonds or the dollar have to catch up. One has to catch up with the other. 10-year yields have gone to 2% and the dollar has not moved. So
Yeah,
you can't have that. You can't have that.
I mean, it's proof that this market is completely regulated / manipulated in one way or the other. But trust me, this cannot go on forever. I mean, if they could keep markets manipulated, forever, trust me, they would have done that in advance. Yeah, they have a very extensive network, all the central banks, trying in the same direction. But at some point, something snaps. And when you have put on so much force to keep the market subdued in such a way and make the market completely oblivious and ignorant to whatever fundamental factor that is in play in the background, and then for some reason you lose control of that, then you're going to see tectonic changes in what's happening with the dollar, in what's happening with stocks, in what's happening with bonds, and then that's going to be the period of time in which you want to be in the markets and you want to step on the gas, right? Because there are periods of time that you need to use less leverage, take less positions, and be less involved with the intraday movement of the markets. And there are periods of time that you need to do the exact opposite. You need to have more positions than you usually do. You might want to use more leverage because you have higher conviction, because the moves are very technically clear, and the markets, instead of being trapped in ranges, consolidating, being choppy, they gain a direction, and it's a very clear direction, and you have extended ATRs, average true ranges for the day, and that's where you want to be there. But as Dale has said many times, in order for you to be there in the good times, you also have to be there in the bad times, right, Coach?
Use less leverage when you trade slow markets. Use wider stops so you don't get picked off. If you don't use less leverage, you might lose your head and your account will be dead. Use less leverage.
It's been a while since we had a song. Thank you, Coach.
Oh, and the opposite. Use max leverage when you trade the markets. Try and turn $1,000 into 10K. If you use max leverage and you're wrong for an hour, your account will go away.
Nice.
Oh my God! I couldn't envision that there would be days that we would have singing time, and still that wouldn't be a problem because nothing is happening.
Hey, it's our show, bro.
Yeah, that's true.
You know, we don't have Roger Ailes at Fox News telling us what to do.
There is another upside. Nobody can ask for their money back.
Or I will pay you guys to come in here and listen to me sing. Who's up for that? That's what I do when I go out to karaoke. I'm actually paying to entertain people. Anyway, so
free ForexAnalytix subscription, so you can listen to Dale.
Yeah, there you go. All right, so
we can have a private just for members singing webinar.
So at times it is pretty tough, our job right here during times of compression in the markets to, I always used to feel the pressure, Steve, when I would facilitate, moderate, whatever you host trading room, that even if I didn't have an idea, I had to come up with an idea, and, I would rather have people be bored than just come up with something to sound like I know what's going on all the time, because I certainly don't.
Oh, absolutely. Absolutely. As I said, there are periods that the market is telling you to be very, very cautious. And, instead of forcing it, you have to embrace that.
DJ said that singing was torture. All right, I'm okay, DJ.
I totally
I'm wiring a refund for the face. In fact, I'm kicking you out. Oh, no, I'm not. I'm kidding.
No, of course not. Okay. Speaking of which, not a lot has changed since yesterday. That's why I was not in a rush jumping on the charts, but there are a few things I want to show. Okay. So those of you that managed to survive Dale singing, I'm kidding, coach.
I've survived it for quite some time, so it can be done.
Yeah, indeed. Although, admittedly, we hear differently our own voice. So I don't know if it counts. Okay, having said that, a few charts that I think that we need to pay attention to because they are on key levels. One is the DXY. Okay, the DXY is currently testing this descending trend line resistance. As you see, it's a valid trend line because this is the fourth time we've been testing it. So it's not like I found 2 points on the chart, I drew a trend line, and I'm hoping it's going to work for a third time. This is the fourth time that we tested it yesterday, and we've stalled here. So bottom line, DXY on resistance. So if you're looking for some dollar weakness from here, I think that's a good entry area. Okay. Now, USD CAD, I showed it before. Bullish case scenario, this being a descending wedge that has formed just above the critical confluence of supports that passes from 130. Still a very appealing risk reward opportunity. The same thing will happen if we push lower once again towards 130 and then we rebound from there. So USD CAD also at an interesting juncture. The cable, I showed it yesterday, we pushed lower, and guess what? We're now at the confluence of this descending trend line. Now, if you want to draw that resistance as well, it looks like a descending wedge. Of course, to confirm that it's a descending wedge, we have to break above 125.80, but it might be. And the spike low that we had in January, which was the yearly low, it was just a spike. And as I was explaining yesterday, if you want to find when was the last time that we were trading that low, you have to go back in April 2017. So you like cable, you want to fade dollar strength. This is an excellent place to be buying it. You can have a tight stop loss. You know when you're wrong. Okay, as simple as that. Pay attention. I wouldn't keep that stop loss extremely tight because it is quite often that you might see a little bit of an overthrow, even if this is a wedge, to see something like this. Okay, usually this kind of overthrows on a wedge are the last move that pushes out of the market the weak hands before the market actually reverses. Okay, so I wouldn't be putting my stop loss like exactly below the spike low, let's say at 123.70. I would leave a little bit more room if I was interested in trading this. Personally, I would be interested to trade that if we see something like this, and then we break above this wedge's resistance. So I'd rather lose a little bit of the upside and have more confidence in that trade than the opposite. But I know that people on occasion, I also do it on occasion, like something so much that, they want to jump with like a reduced position perhaps in advance. Okay. So that, concludes what I had to say for cable. As I said, also at an important juncture. Now, another thing I first talked about a couple of days ago, the S&P. And if we go to the NASDAQ, you'll see that it's quite similar. There is potentially a wedge here as well, an ascending wedge both for the S&P and the NASDAQ. So I do see the potential for a deeper pullback before continuing higher. Let me be very, very clear, as I did when I shorted it there. And I got lucky enough because I got filled in my target right before the market reversed. I'm not looking like for a, reversal and the beginning of a bear market from here. I'm talking about a simple pullback, right? A corrective pullback. So don't misunderstand. So I do see the potential for a pullback here in stocks, both in the Nasdaq and S&P. So that's another thing to monitor, especially if you see the S&P is currently testing support of this ascending wedge. Now, let's have a look, which we didn't do yesterday, of what's happening to bonds. So the Bund moved lower after breaking below this channel. It's now recovering higher. Do I believe that we found a low after this move lower? I'm not that convinced. I would feel much better if I saw something like this. I'm not saying that you should disrespect the uptrend, which clearly remains in play. Okay. I'm saying that I would find it quite likely to see one more leg lower, complete a correction, and then continue higher. So that's what I think about the bunds. But keep in mind, it remains one of the strongest markets out there. And as you see, we have a clear underperformance in the treasuries. So I think it's much easier to envision why the treasuries can continue lower to at least retest this ascending channels support before likely continuing higher. Okay, now of course, if we break below that ascending channel support, then it's a totally different game we're talking about, but there's no reason to go over that in advance. I mean, we're here every single day. Even if it happens, we don't cover something like the bonds every day. We're going to cover it every second day. So, we're going to be there in advance. Now, you remember I was saying that for some time, we have had a major event happening in the gold silver ratio. Not only we broke, this is the long picture, the long-term picture, not only we broke above this ascending wedge, which can end up being an overthrow, but then we failed from this ascending channel, and this move lower so far looks very, very impulsive in nature. Let me tell you that we found a high almost at 93.5. So bottom line, you needed 93.5 almost ounces of silver to buy 1 ounce of gold. There was only one period of time in the past that gold was more expensive in comparison to silver ever. It didn't last for a day or two, but there was only one period of time in the past. So this was the second time in all times that the gold-silver ratio was as high. We didn't hit a record. The record was roughly at 100, but that's not that far away. But most importantly, this move lower looks impulsive in nature, which means that even if it's a corrective move, it's a corrective move that will keep unfolding for some time, most probably. Bottom line, one of the best opportunities out there, in my opinion, is shorting any rebound in the gold-silver ratio. Yeah. And it's also a trade that is completely unrelated to what is happening currently with the dollar. So bottom line, this choppy environment in the dollar cannot work against you in the gold-silver ratio, because having to do with the way that dollar factors in what happens with gold, in the exact same way it factors in what happens with silver.
It's a mean reversion trade.
Yeah, it is a mean reversion trade, but for several reasons, I also like it purely.
Technically, it's finally telling us we could get a mean reversion.
Yeah, exactly. So I do think that the gold-silver ratio, still, I know that some people look at this and they're like,
how are you going to put it on, Steve? I mean, give us the contracts of how you would structure this trade if we get
you
this
don't
bounce.
Need, I mean, there are several ways. I don't know how.
I mean, the only way I knew is I told people exchange your gold for silver, physical. So how do you put on a derivative trade?
There are several ways to do that. Several ways. There are even brokers that offer gold-silver ratio. But even if you
That's
don't
the
have
easiest. That's
yeah,
the easiest.
even if you don't have access to any of that, even if you don't have,
Americans wouldn't have that CFD, I don't
yeah,
believe.
even if you don't have access to any of that, you would still be able to do it in the following way. You sell gold and you buy silver on the market, equal amount.
Okay, but you can't. How do you do it in futures? Like gold's 100-ounce contract. There are no 100-ounce silver contracts.
I don't know
there
what.
are 1,000-ounce mini silver.
Yeah, that would make it quite difficult. And I mean, it's not difficult, but you will need to go in with volume to match up 10.
Yeah.
Yeah. Okay. Yeah. Yeah. You'll have to mathematically match it up to be the same amount. That's it. As simple as that. Or
Same amount of capital, so you use the same
yeah,
amount of
yeah,
capital.
Same amount of capital.
And then
Yes.
figure out how many contracts are close
Exactly.
enough to it.
Exactly.
Yeah.
Thankfully, I'm in Europe. I never had to worry about that.
Right.
I have access to CFDs.
Well, I told you I'm driving over to Greece. this
Yeah,
summer.
which makes it very, very, very simple to trade gold and silver. Yeah, I mean, in my broker, I just buy as many ounces or sell as many ounces as I like, you know,
Okay.
gold or silver.
What a great segue to our guest, who says,
yeah, we are at the top of the hour.
Yeah, in gold we trust.
Yeah, absolutely.
Is one of their taglines at Incrementum. So
I honestly believe with the current monetary environment, I don't care if somebody's going to call me a dinosaur, a gold bug, although I'm not. It's not that I'm all in gold or whatever. But whoever doesn't realize that it is inevitable that anything that is tangible is going to keep appreciating against fiat currencies, you know, you just can't.
Steve, when I like gold in 2000, and that's when it bottomed at 200. Okay, people are calling it an archaic relic.
Yeah, and
just like they're saying now the VIX is broken. Same thing.
An archaic relic, but if they bought it at 2000 and they held it to today, I'm not even saying, you know, the theoretical if they had sold it at the highs, because, you know, nobody sells at the highs. You have to be lucky. But even if they had kept it up to today, they would have made 7 times the money, right?
Yeah.
Plus
I think God can sell short every top and buy every bottom, and that's the only guy.
Yeah, most likely.
Anyway, should we get to Ronnie now?
Absolutely. Enjoy the interview. I'm going to stay on until he.
Okay, thank you, Steve.
He's up and running.
Ronnie, I'm looking so much forward to talking to you, especially with what's going on in the markets. I'm going to unmute you, and you'll probably have to hover your mouse. I hope you have a mic. And I'm not sure if you're playing.
Can you hear me?
I can hear you, Ronnie. How are you?
Very good, very good. Can you see me as well?
No, but if you want, you can both enable your webcam. You can also share your screen if you mouse over this little panel that expands for Zoom. As you see, there are buttons. One of them says start video. So if you want to show your webcam, you can press that button and you can start, you know, your webcam. And if you click on the button,
Ronnie may not have anything to show. Are you going to show it? Do you have a screen to show, Ronnie?
Yeah.
Oh, okay. Because I have your website up. So
yeah, there is a green button that says share. If you click on that, it's going to ask you if you want to take the screen from me. You say yes, and then you select the screen you want to show.
Yeah.
Okay, perfect. It's coming up.
What do you see now?
Okay, we see
trust in many areas of life and society is crumbling.
Yes, I just have
in
to
gold
start.
We trust. Goldfinger.
I didn't know that Johnny Cash is still alive. Actually, I heard you singing before.
Oh, John. Oh, yeah, he is. In fact, I do his new song "Hurt," which is really a downer. But anyway, Ronnie, it's great to have you with us today on Face. I want to thank you for taking time out of the day.
Thank you very much
To be with us. have we done this before, Ronnie? Have you
Never
and I
actually.
talked?
You've had one with my colleague Demelza Hayes, I think.
Oh, you're with Demelza. Okay.
Yes.
All right. Great. So I knew Incrementum looked familiar to me. So she was great. And
Excellent.
yeah, really nice to have probably how many people hold doctorates or working on doctorates in blockchain?
Yeah, that's true.
Is that
That's
kind
true.
of unusual?
It's actually pretty scary how smart she is.
Okay.
It is, given the fact that
Merrier.
she's so young.
Oh, okay.
Can you see my full screen now?
Yes,
Yes,
got it.
yes.
Excellent.
A new gold bull market ahead. So, Ronnie, since we haven't talked before, it's always
Let me
interesting to
assume that you're
me.
bullish.
It's always interesting to me and our audience how you got into the financial market field.
Yeah, of course. Well, I started buying stocks when I was 13. Made lots of money through the dot-com boom, lost even more money during the dot-com bust.
Okay.
Went to university, tried to learn something about markets. It was a complete waste of time, but I worked in credit derivatives trading and afterwards started as an analyst at a bank. And in 2007, I started writing my In Gold We Trust reports
Okay.
because I owned a gold mining stock that did pretty well. And I didn't have any clue about gold, about the monetary history, about how the whole system works, how money is created, because of course they don't teach you that
But
on
isn't that a
university.
tradition in your part of the world that, you know, when you're 1 years old, your father will give you St. Gaudens, so you know about gold and the fact and that it's real. If you drop it
Yeah,
on your toe, you feel it instead of
yeah.
fiat. Huh?
There is I would say in our monetary DNA,
Yeah.
there's gold. Gold is definitely important for us due to the hyperinflation that our grandparents lived through, and you know all
Right.
the currency reforms, including the euro, of course.
Right.
So gold is physical gold is definitely important over here in Europe. When I just returned from Greece, actually, I had a fabulous vacation on a Greek island called Kefalonia. And it
Oh,
was interesting.
Steve's going to have a comment on this. Are you there, Steve? Maybe he walked away. Okay. So you were taking a vacation, recharging your battery. Go ahead.
Yeah, and it was interesting to talk to Greek people about gold and their affinity for gold and what it means for them, especially during the crisis that they had a couple of years ago. And then also, of course, you know, I'm always talking macro, and most people just don't see that the euro is way too hard for most southern countries like Greece, for Italy, and so on. So for the Greek people, but also for people over here in Austria and Liechtenstein, gold is just a monetary insurance policy, I would say.
Okay, so the old expression is don't wait to buy gold and wait. But are you price sensitive to levels as to, you know, I know about holding a physical, but do you ever say it's right to sell gold?
Well, I mean, in 2011, I would say when all the big Wall Street banks were extremely bullish already. Don't forget that Goldman, J.P. Morgan, Citi, they had price targets between 2,500 and 3,000 US dollars. So everybody was screamingly bullish back in the days. That should have been a good warning signal, of course. But at the moment, it's completely the opposite. Basically, everybody is expecting gold to go sideways or lower the next couple of years. And from my point of view, we are in a new bull market.
Okay. So the new bull market really probably started after the correction from 1900 at 1050. And recently, we've broken out of a 3-year consolidation pattern. Say, call it ballpark 1365, 1375. What kind of targets are you looking for in this new bull market, and what kind of legs does it have as far as time?
Mhm.
And is the main thesis that central planners are going to keep rates low and push more bonds and instruments into negative yield territory, and that's one of the major catalysts for this new bull market.
Well, first of all, I think the whole breakout above this massive resistance zone at 1360, 1380,
yeah,
it clearly showed that there's a macro regime shift happening. We're seeing increasingly dovish comments by central banks. Recession risks are strengthening. That's absolutely clear. It's not only the yield curve, but also Federal Reserve New York showing now really, really high recession risks. And actually, you know, recession is not something to be scared of. It's something normal within a business cycle. But we all know what's going to happen in a recession. We will see lower rates. We will see fiscal stimulus. We will see further rounds of QE, perhaps MMT, helicopter money, you name it. So that should provide a positive environment for gold. Then I think it's important to say that gold as a zero interest yielding asset is clearly a long duration asset. So as the market moves to the view of lower interest rates, gold should not only begin to outperform shorter duration asset classes, it should basically exhibit a very high inverse correlation to bond yields. And from my point of view, what we've seen recently, this high correlation between gold and negative yielding bonds, that's gonna continue. I think it's
let me ask you this.
Yeah.
Is along with your view on gold, does this also make you a long-term dollar bear?
Well, that's a tough one. I've got many friends being structurally extremely dollar bullish,
Right.
and I see their points. Yeah, but so far at the moment, right from a technical point of view, I think the dollar is like a stock that doesn't rally on good news anymore. So from my point of view, I'm not a structural, let's say, Euro bull, but I think, you know, everybody is super bearish the euro. Everybody knows that Germany is on the verge of recession, that the problems in the southern countries aren't solved, that we haven't seen the Brexit yet. The market has already discounted that. But if there should be a US recession, if the S&P should move into bear market territory, I think that's going to be something that the market has not discounted already, and that's going to push the dollar lower. From a longer term point of view, I just like gold as a currency versus the euro, versus the dollar, versus the Canadian dollar, Aussie dollar, whatever.
Against
I think it's
everything.
the strongest currency. Yeah, exactly.
And isn't that really the force behind any new bull market, that gold is appreciating across all currencies and not a few isolated ones?
That's something that I want to show you. Can you see my slides?
Yeah, I go back to the one where the world is crumbling. I think it was one of your first ones, but there's Mario and there's Jay, Truss and Central. There, Truss and Mario.
That's just, it's a bit of a philosophical start, I would say, because the topic of trust and the erosion of trust was the leitmotif of this year's In Gold We Trust report. So we said that trust not only in politics is crumbling. It is no coincidence that populists on the very right and on the very left side of the spectrum are winning most elections nowadays. It is a sign of this growing inequality that is also caused by our monetary system, of course.
Does this remind you of the 30s at all, this political movement?
Unfortunately, yes. Unfortunately, yes. Okay. And I think that you know, when you're studying gold, you also, of course, study history and monetary history, and I think there are many parallels, unfortunately. And I think that
you want to move to the next slide.
Yeah, I mean, we've seen this loss of trust a couple of years ago, and we shouldn't forget that trust is something very asymmetrical. So it takes ages to build up trust, to foster trust, and then you know, within seconds or just a few moments, it can be wiped out. Let's not forget Lehman Brothers was founded in 1850, and in 158 years of existence, they haven't had any quarter with losses. And then just 1 week and the market lost trust in Lehman's liquidity and it was over. So trust is something really important. And from my point of view, trust in central bankers is waning, because we have seen this massive U-turn after 10 years of a liquidity party where central bankers created 18 trillion US dollars out of thin air. Last year in fall, they tried to get out of this liquidity party. They wanted to take the safety net out. And we have seen what's happened in equity markets. So we've clearly seen how addicted the market is to liquidity, to further QE and so on. So from my point of view, the market at some point has completely lost trust in Jay Powell, in the Federal Reserve, in central banking itself. We shouldn't forget that like 1 year ago, the market was seeing 3 to 4 rate hikes in the US, and now we're discounting rate cuts and the end of quantitative tightening. Over here in Europe, Madame Lagarde, she's a lawyer, and actually, you know, what do you do at the IMF? You basically restructure countries. So from my point of view, it is pretty obvious that the ECB is in the zero interest rate trap. They cannot get out. They already signaled that there will be further quantitative easing. From my point of view, Lagarde at some point will introduce Eurobonds. So I would say if a recession hits, then on a relative basis, of course, the US is in a better position because they've got more leeway and wiggle room to lower rates, while in the Eurozone we are still still have Mario Draghi will end his career as a central banker without just one rate hike. And that clearly shows you that we will see much more aggressive measures going forward, and that should be a pretty good environment for gold. And as you can see here, I think, you know, the skeptics, those are financial market participants that were waiting on the sidelines. They will be entering this trade again. As soon as gold price rises, we'll see ETFs pushing into the market. We are seeing that there is further moves in the or volume kicking into the mining space and so on. And we have seen the last couple of weeks that there is some sort of buy the dip mentality starting now in the gold space. And
you have a comment on how on the gold silver ratio, which we talked about in the 90s, seems to be changing. And do you buy the maxim that all true bull markets, or at least the speculative side of a market run, is led by silver? And do you think this mean reversion in the gold silver ratio could continue?
Well, I would say that silver is some sort of a sentiment indicator on gold. And the fact, normally in the very, very early stages of a gold bull market, silver under... Exactly. So I think at the moment there's many people considering going into the gold, into gold mining stocks and so on. And actually, the last couple of days we've seen a massive reversal. We've seen massive volume in the silver miners. We have seen the gold silver ratio dropping. So
that's what I'm saying. So
exactly. So
that's a report. What a reporter would say. So a guy like you, do you think, I remember being around when the gold silver ratio traded a lot in the 40 range. Do you think that we're going to have a mean reversion? Do you have any feeling as to where this ratio could come into?
Yeah, I mean, on average, the ratio, I think since 1900 was trading around 40 or 42. Okay. And it is a mean reversion trade, and actually just the last couple of days we have attracted the strongest monthly investor inflows in ETFs and based on a COT. So there is something happening,
Yeah.
but still the pure price picture doesn't convince me yet. But we should not forget silver is a tiny market. So if there's really investor demand kicking in, then we can go to 2025 pretty quickly.
They say, Ronnie, that the gold share, all the mining companies, the capitalization of all of them put together is so small. It's when money comes in, it has to go through like a garden hose. And then if it was silver, it would have to go through something with even a smaller circle. So it doesn't take a lot of money because the capitalization, especially as decimated as mining shares have gotten over the last few years, it doesn't take a lot of money to move them. Is that correct?
Yeah, absolutely correct. But what I would like to add is that silver is more of the inflation metal, while gold usually performs pretty well in deflationary environments as well.
Right.
So,
Okay.
so I think, of course, inflation, nobody's talking about inflation at the moment. And, you know, those, I don't know what the number now is, 17 trillion with negative yielding bonds. What is the biggest pain trade for them? It is rising inflation.
How about, okay, well, you sound pretty sanguine about rates, that the central banks are control it. I'm of the view that we either have or there's one more decline in yields, but that yields are going to be the yields going up is going to be the biggest surprise to the market, because most participants are going to say, how can 10 and 30-year yields rise when the Fed is easing?
Yeah, yeah. I mean,
Do you
yeah.
think yields could go up?
Of course, they could go up, yeah. But still, I think we don't see for the on a relative basis, yeah. I mean, the 10 years don't look so bad, and we still don't see, despite the fact that we've seen such a big move, we don't see any big optimism in the US bond market. I think over here in Europe, valuations are just nuts, and if you see, you know, Greek debt trading lower than or yields being lower than for the US 10 years, that tells you quite a lot. But
yeah, that's interesting. So I mean, they would be the short.
Yeah, I agree that there's an illusion of control of central bankers. And I think if this illusion starts to crumble and the trust starts to crumble, and you know, we shouldn't forget, equity markets are basically at their all-time highs. Real estate markets all over the globe are doing well. Bond markets are basically at their all-time highs. We're seeing kind of a Goldilocks scenario still in the economy. So nothing happened yet. But if there is this shift happening, and from my point of view, gold is kind of indicating this macro regime shift, then I think we'll really see the big moves. But we haven't seen anything yet.
You know, Larry Williams used to say, when the market goes up and gold's going up at the same time, it's not a good sign, because gold going up is like saying the economy has a fever.
Yeah, I agree.
You like that?
Yeah.
So, so the temperature's rising. It was, you know, 100, and now we're like at 101.8 on the thermometer. So, why don't you just continue? What a great PowerPoint and interesting interview, Ronnie. I know that you guys, you're with Demelza. You also believe in crypto, correct?
Yeah. I mean,
what do you like more, gold or crypto?
I personally like gold more.
Okay.
I think that, you know, we are now launching a fund with 75% physical gold and 25% Bitcoin, and because most people cannot stand the volatility of Bitcoin. I'm very critical when it comes to all those altcoins, but I think Bitcoin is some sort of digital money. It is an basically anti-government money, anti-fiat money, and I think there are many similarities actually between Bitcoin and gold, like the high stock to flow ratio and so on.
I see zero. please convince me against that. Let's begin by the very, very basic. Gold has intrinsic value.
No.
Gold doesn't have intrinsic value.
No. What should the intrinsic value of gold be?
So wait a second. If tomorrow, for some reason, gold is not accepted as money, for some reason, it has been for 5,000 years, but let's assume that tomorrow everybody on the globe decides, okay, we're not going to accept it as money anymore. Won't it have value? Isn't it going to be used in jewelry? Isn't it going to be used for transistors? Isn't it going to be used for so many applications? That is its intrinsic value. Intrinsic value, in essence, is if you cannot sell it anymore to somebody else or exchange it, what do you do with it? I can tell you what you're going to do with Bitcoin, if that's the case, if there is no faith in for somebody to get it off your hands because they know that somebody else is going to accept it. But for gold, sure, I know it's not going to go to waste. So are we really going to debate if gold has intrinsic value?
Well, I think I've got a different definition of intrinsic value, but that's, you know, I'm very much influenced by the Austrian school of economics that says there's value is always very subjective. So let's say, you know, the value of a Picasso painting, yeah, what is it? Is the intrinsic value actually what he paid for all the colors and stuff, or is it what the market wants to pay for this Picasso painting? From my point of view, when the shit hits the fan, then you talk about this, let's say, stress, liquidity, and stress prices of assets. And then you're gonna see if the Picasso painting sells for $100, like $100 million, like in the bull market, or for I don't know, $5 million.
I'm in total agreement with you.
And when it comes to gold, I think, you know, it just has a 5,000 years track record compared to Bitcoin. You know, there's a huge advantage, of course. But what is really, from my point of view, really puts the monetary value on gold is the high stock to flow ratio. So at the moment, there's 190,000 tons of gold, and every year there's 3,000 tons mined. So the stock to flow ratio is extremely high. So your natural inflation of the physical gold that you're holding on average is 1.6%.
Yeah, but you're ignoring something very basic here. Gold is only one, and its physical properties is what makes it stand out from the vast majority of the metals. It can trust, for example, etc., etc. So there are many applications that can only be done with gold or with similar, very expensive metals. The difference being that Bitcoin, yes, does it have a limited supply? It does, but who limits the ability to create infinite number of cryptocurrencies with the same or even better properties than Bitcoin has? Nobody. While gold, it's a specific mineral, it's a specific metal in the planet. We cannot decide that we want it to multiply 50 times and, you know, we snap our fingers and we make it happen.
Yeah.
So that's a huge difference, which makes this comparison, in my opinion, unfair. Plus, you talked about inflation in essence. And let me ask you something. My son has lately, he's 3 years old, and he has lately started painting. You know, you can understand what a 3-year-old is painting. So let's assume that he stops after having painted 100 pieces of paper. So, you know, that's something that is going to have a very low inflation. Will that assign it a very high value just because there won't be any more paintings of my son out there?
No, of course not.
Because for something to gain value, also based on the fact that there is no high inflation, which erodes value, and we 100% agree on that, it has to initially have value. Because I can tell you many things that have no inflation, but remain worthless because they always were. So for me to be convinced that Bitcoin is going to survive, and let me be very clear, I'm not doubting that the world is going digital. I'm not doubting it at all. What I'm completely uncertain about is, why would Bitcoin survive and not something else? Why wouldn't it be replaced by something that will also be a medium of exchange, because Bitcoin cannot make many transactions per hour, so it can never
Yeah,
be
yeah.
a medium of exchange. So
No,
yeah.
yeah. No,
Yeah.
I think that, am I sure that gold will have probably a higher purchasing power in 5, in 10, and in 50 years? Absolutely, yes. Am I sure that this is gonna be the same for Bitcoin? Not so sure. Definitely. And from my point of view, the important thing is that people are discussing money again. And they're discussing, is gold money, is Bitcoin money, what is better money, what is the advantages of Bitcoin versus gold, what are the disadvantages. And I think this is a crucial discussion, because people nowadays, they talk about all the shit on Instagram and Facebook, but nobody wants to talk about really important things that affect us all. And one of the most important things that affects us all and is the root cause for many problems is money. So therefore, I really appreciate the discussion that is going on. And I appreciate the fact that there's many young people all over the globe trying to find good solution nowadays. Lots of the stuff that was published and sold was wiped out already, are scams and whatever. But I think that digital assets will be here to stay. From my point of view, Bitcoin will have the big test. If we see a recession, if we see markets crumbling, then we are really gonna see the advantages or the disadvantages of Bitcoin. Because let's face it, we haven't had one big cycle, one big business cycle in Bitcoin yet, and I'm not sure how Bitcoin is gonna perform when the S&P crashes.
I agree 100% with you. It might work as a hedge, but it might do the exact opposite. I mean, people might,
Yeah. I mean, there are times like if rates go up in a crisis, people, and cash is king, people will sell everything to raise cash in a liquidity crisis. I think that's a possible scenario. Why can't everything go down? Everything's gone up together. Why can't everything go down together?
Yeah.
Do you think that's a possibility, Ronnie?
Of course. And I think, coming back to gold, we have seen in 2008, actually, here it is. 2008, gold was up 5.6%, but during those weeks when Lehman went down, when we had all the mess with AIG and so on, gold was down, and many people say it was manipulated. Yeah, perhaps, I'm not so sure about it, but gold is extremely liquid. And within those stress situations, you want to sell liquid assets. And the thing
you can't
about
sell a house at the market.
Exactly. And the thing that I want to show in this slide is it is important to see that gold is now rising in every currency. In euro terms, it is up 13% year to date. In dollar terms, gold is up 10%. Gold is up, in Australian dollar terms, in Canadian dollar terms, we're close to new all-time highs. So gold now really is in a new bull market, and a bull market that most people don't really appreciate yet.
Ronnie,
they will get to appreciate it though.
And that's actually a pretty interesting chart, because we were talking about the gold-silver ratio before. That's some sort of correlation between the S&P and the gold-silver ratio. Here it is inverted, the gold-silver ratio, and it shows that there was a pretty high positive correlation back in the days between the S&P and the gold-silver ratio, but this kind of snapped in 2014, 2015. So from my point of view, this is a sign that the monetary inflation that we have seen mostly spilled into financial assets and not really into into real assets.
Financial engineering.
Yes. Yeah.
Okay, so let me ask you this on financial engineering. I've thought about this. So a lot of people are very worried about, last time it was housing. This time it's the corporate debt market, because rates are so low and it's huge. And they use those proceeds not for new plants and equipment, or maybe even mergers, but for paying out dividends and buying back stock. So is every multinational corporation leveraged to the hilt through financial engineering by buying back their own stock with cheap money? And what happens if the cost of money goes up and the market declines? Will that exacerbate the situation?
Yeah, of course. I mean, I think the biggest bubble nowadays is in the corporate bond market, and we know that this is the chunkiest corporate bond market that we've ever seen. That 50% of investment grade is close to being downgraded.
So what's a pin, Ronnie? Ronnie, what's a pin that pops this bubble? Recession?
Actually, forecasting a black swan is kind of impossible per definition.
Well, give us a couple white ones.
Well, first of all, I think some would, of course, be geopolitical.
Interesting.
We all know what's
like
going
an oil
on
shock?
with the, U.S.-China dispute. I think this is one of the most, most agreed things nowadays in the U.S. that China is evil and that they have to do everything against the Chinese. And I think that the Chinese really they play the long game. They are not interested in a short-term deal.
Yeah, Xi doesn't have to be reelected next year.
Exactly. So geopolitical risks, of course. Then I think it's just economic numbers in 85% of all countries. At the moment, we're seeing weakening numbers compared to 1 year ago. So it is really a global cool down. It is not only in the US, in the Eurozone, it's all over the globe, actually. We're seeing an earnings recession already in the US. So 3 quarters in a row, we're seeing falling profits, despite the fact stocks are still reaching new all-time highs. But, if you dig a bit deeper, Dow Jones Transports and the small caps are far from confirming new highs. So I think, there's already many signs that the market structure is weakening. The market breadth is getting weak.
Does your fund plan to take advantage of, I could tell just from talking to you for a while that you expect a mean reversion in the stock market as well. Are you speculating on that event?
Yeah, of course. Yeah, we can go short, but actually, to be honest, we've been short already a couple of times, and we clearly underestimated the strength of this bull market, and this.
And others.
Yeah, this collective corruption, as a friend of mine once called it, that there's so many people and institutions actually interested that this will. That we're just gonna kick the can further down the road. But from my point of view, we're seeing recession risks being very high. We're seeing volatility still being extremely low. We're seeing that equity markets valuations are really high. And what's the best hedge for such a scenario? If there is a trend reversal, it is gold. Gold is a pretty good recession hedge. We've got a couple of slides here.
Okay. Oh, we are here. Yeah.
And that's just a very interesting long-term chart that I wanted to show you. That's the GSCI, so the commodity index versus the Dow Jones. Commodities can stay undervalued for a while, but this level of undervaluation is just
we're back to 1960s when I was really having a great time. Anyway, Ronnie, it's been what a great discussion, and getting Steve involved in it too. Really, that's the feature of this interview, is you guys discussing Bitcoin and gold. This be a good time to show us your website, if you'd like, Ronnie, and where people could follow you. Do you guys have a newsletter? And
absolutely. Well, newsletter. We publish once a year the In Gold We Trust report, which is probably the most widely followed publication on gold.
You want to show your website on the screen?
Yeah. Where do we have it? Yeah, there it is.
Okay.
In Gold We Trust .report. You can download the most recent study, but I have to warn you, we made a new all-time high, so we wrote 330 pages about gold, but it is a holistic analysis of gold. It's about the status quo of gold. It's about de-dollarization. We're writing about Exter's pyramid. We are writing about the portfolio characteristics of gold, where to best store your gold. We're writing about the Plaza Accord. We're
Where is
writing
the
about,
best place to store your gold?
well, I like Liechtenstein, I like Switzerland and Singapore.
Okay, so you really don't have physical possession of it.
Yeah, no. I mean, I think the Doxbone strategy makes sense. So diversifying, and that's actually something that the really ultra high net worth individuals at the moment are doing over here in Europe. They are diversifying their gold holdings, so they don't have it only in Switzerland. They've got it nowadays in Singapore, in Hong Kong, in Sydney, whatever. And that's a really big trend over here.
Okay. All right. So I appreciate that too, because a lot of people have the belief and the proponent that you should have physical access to it. Of course, you have security of that investment.
Yeah.
You do that. So
Yeah.
here it's safe. Have you ever made a trip to go say hello and visit and kiss your gold bars?
Of course, yeah.
In Switzerland, you go there and play with it like King Midas?
Yeah, I don't kiss it usually. My wife wouldn't appreciate
You're a great
such.
sport, Ronnie.
No,
You're
but
great.
that's important, yeah.
Okay. All right, Ronnie, I had a great time. I hope you
Me
enjoyed
too.
it. I hope
Thank you very
enjoyed
much.
it was really a great time for people to really look seriously into some shifts that are happening here. And who cares if gold pulls back to 1250 in a macro environment? It could happen. We all know everything can happen in the market, but the arguments are solid. If you really want to learn about gold, you just heard, one of the most expert presentations in it, and we didn't even scratch the surface. So thank you so much, Ronnie, for edifying our FACE community.
Thank you very much.
Yeah, the video will be out
Thank you.
in a few hours. And Steve, thank you for joining in. That was a great debate.
My pleasure.
And Ronnie, like it or not, and I don't know if you trade, but either way, you're now my trading warrior brother.
Thank you very much.
All right. Anyway,
Have a good one.
All right, everyone. That's Ronnie Stuffler, and you have to follow him on Twitter and get his gold report and educate yourself for this new era that we're moving into. And that's a wrap for us, everyone. Have a great rest of the day. Remember, don't just count your Krugerrands, count your blessings, and we'll see you all tomorrow.
Thank you very much.
Thank you, Ronnie.
Bye-bye. Bye.